Hey everyone, my name is Andrew Gordon, and we're going to do a live Q&A today in the cryptocurrency investing group, talking about crypto taxes. So we'll give everyone a few minutes to start joining. But if you have questions about taxes in general, or specifically about crypto taxes in the United States, get your questions ready. Feel free to comment and ask any of the crypto tax questions that you have. In this video today, we'll try our best to answer all of your questions. I'll also talk about different news and updates in the IRS crypto world, some things that happened even in the last few months, some things on the new 2019 tax return that you should be aware of if you're a U.S. person. And we'll also talk a little bit about strategies, things that you can use to minimize your crypto taxable gains, both in prior years and in 2020, in the current year as well. So if you have any crypto tax questions, if you're a United States person, if you're filing a U.S. tax return and you're not sure how to report your crypto, ask away, start commenting, and I'll try to go through as much as possible. So I'll give everyone just a couple minutes to join. I'm checking now to see if there's any questions yet. But just comment on this feed if you have any questions. So something that happened actually recently that everyone should be aware of is the new 2019 tax form. So it's 2019 tax season right now. And the 2019 tax form is due on April 15th for individuals. You can get a 6-month extension. It's an extension to file, but otherwise it is due on April 15th. And so something that's new this year, and it affects basically everyone that's in this group, is that the IRS is asking everyone that files a tax return whether at any time in 2019, at any time, did they send, receive, sell, or otherwise acquire cryptocurrency during the year. And this question is on Schedule 1 of the tax return. It's the very first question. So it's right at the top of Schedule 1, and it says at any time did you send, sell, receive, or acquire cryptocurrency. And you have to answer this honestly, and there's a yes or no checkbox. There's not an I don't know, there's not an I'm not sure. You have to check yes or no. And so if you sold crypto, if you exchanged it, if you received it as income for payments, for services, or for anything that you did, you have to check yes because you satisfy it. But also if you received it as a gift, if you received a fork, any of those things, you also probably need to check yes as well. So that's important because although you might be checking yes, in most cases you'll have other items to report on your tax return, like taxable transactions, but not always. It's possible to check yes and not have any crypto trades to report. However, it's a big warning sign to the IRS. It says, hey, you've got crypto, look at me. And so it's another just way that the IRS is drawing more attention into the space of crypto. So now more than ever, it's important to report crypto and actually every trade you have on your tax return. Because the IRS is even just asking a very basic question right at the beginning of the tax return, saying, did you have any activity with crypto during the year? And then from there, you should report on Schedule D, which is where if you had stock trades, you would also report it in the same place. But that's where you report crypto gains and losses for every trade that you have is on Schedule D. And one of the biggest misconceptions people have had in the past is if you go from one crypto to another, that it's not taxable. But actually it is taxable. So if you go from one crypto and exchange it for another, it's a taxable transaction and you're going to have to report it on Schedule D of your tax return. One of the questions that I got was, how long have I been working in my field? And I guess I just jumped right in, start answering questions and talking about crypto tax in general, but I haven't talked at all about myself. So my name again is Andrew Gordon, and I'm an attorney, but I'm also a CPA. And I've been working in crypto tax since 2014, so quite a long time. I wish back then I invested along with some of my clients. Maybe I wouldn't be here on this video. I'd be on an island enjoying the sun somewhere else instead. But we've been very active in the crypto space since 2014. And we do things like preparing your crypto tax returns and reconciling your transactions to create a report but our firm, and myself included, we're also very experienced in dealing with IRS problems. So we handle audits regularly, and this is both for crypto audits and just for individuals. So if you have any questions about crypto audits, feel free to ask those as well. But we handle audits, we also handle criminal investigations, and we take matters to the U.S. tax court as well. So very experienced at all levels of dealing with IRS and state disputes. And that's how we got into crypto, because back in 2014, there was little to no guidance. It wasn't until 2014 that the IRS finally said that crypto was property from an IRS tax standpoint. But before then, there was a lot of question, and people weren't sure if it was currency or property. But now there is clarity. And from 2014 until 2019, the IRS actually didn't really say anything. There was little guidance. And so you've probably seen my videos talking about some of the other crypto tax issues, and that's because there wasn't a lot of guidance out there from the IRS. But in 2019, the IRS, for the first time in 5 years, answered some more questions. And one of the things that they did talk about was whether forks and airdrops would be taxable. And so up until the guidance, there was question of whether or not if you received a fork or an airdrop, if you had to pay taxes on it right away when you receive it, or if you have to pay tax when you sell it. Now, it would be ideal and everyone would be a lot happier if you only pay tax when you sell your forked coins. But the IRS actually came and clarified this and said, no, it is income to you. You need to report it and pay tax in the year that you received the actual fork or airdrop. And so, for example, with the Bitcoin Cash fork, which is one of the largest and most popular forks, that is income to you at the time that those coins were deposited into your wallet. So a lot of people used Coinbase, and Coinbase made it known at first that they weren't going to support the Bitcoin Cash fork. And so they actually at first didn't release Bitcoin Cash into people's wallets. So if you had Bitcoin in your wallet, at the time of the fork, you didn't receive Bitcoin Cash. It wasn't until several months later that Coinbase finally regained their senses and said, hey, we're going to give you your Bitcoin Cash. And so months later, they put that Bitcoin Cash into your wallet. So from a tax perspective, the question is, do you need to report any of this? And the question is answered yes. The IRS clarified this a few months ago and said, yes, it is income to you at the fair market value at the time that you received it. So then the next question is, well, if in cases like Coinbase and Bitcoin Cash, where the fork happened on one date, but then you didn't receive it till another, when is the date that you use that you got it, and what is the price that you use? And the IRS here also said something that we also expected, which was that once you actually receive it, once you have possession and control of it, you have custody of it, that is the time, the date that you report the income and also determine the fair market value. So in the example of Coinbase, you don't pick up income at the price of when the fork occurred, but instead you should pick it up on the date that the coins were actually placed into your wallet. So a little bit different from a timing perspective than if you were holding the Bitcoin and then the fork occurred and you got the Bitcoin Cash right away. So for some people, they view this as unfortunate. A lot of people disagree that airdrops, for instance, every time you get a shit coin, that it needs to be taxed. But the IRS has basically said that even with, it doesn't matter what the property is, if you have an ascension of wealth, if you gain something new, you have to determine the fair market value and pay tax on that. And so with some shit coins, it may be pennies, it may be only a couple bucks, but you need to report it. And it's also important to report this because it can help you. It establishes your cost basis, but also your holding period. So let's say you get, let's just call it ABC coin on an airdrop. And at the time, it's only worth $1. And you say, I don't really care about this. It's not important to me. It's ABC coin. It's worth $1. Well, first of all, the IRS would say you need to pick it up and report it on your tax return as income. But now later, let's say 5 years pass and you sell it, and because it's now ABC coin is the new Bitcoin and it's worth $1,000, you will have to pay tax on the gain, the spread between the price when you received it and the sales price, you'll have to pay that either way, right? But what's really important is the holding period, because the tax rate for crypto that you hold longer than a year is 15 or 20% generally, whereas the tax rate if you sell crypto that you hold for less than a year is at your ordinary tax rate, which it varies depending on your income level, but it can be 30 to 37%. And so in many cases, double the short-term, double the long-term rate for the short-term rate. So one of the best tax strategies that you can have is to hold crypto for longer than a year and then sell the crypto then. By doing that, you would have a long-term capital gain, which is taxed at a lower rate. So in the example of airdrops, it's important to pick up that initial income, show that you report it, even if it's for a few bucks, so that way when you sell it, you can say to the IRS, this airdrop, this ABC coin, was in fact acquired years ago. It was reported on the tax return, and so it's a long-term capital gain. And so again, a great strategy is holding crypto long-term, which gets into another area that the IRS a few months ago, when they issued some guidance in 2019, talked about, which is specific identification. So another big question that a lot of people have been asking for years is, if I buy a bunch of crypto over time, and I also start selling that crypto over time, how do I determine my cost basis? Which crypto was it that I sold? Is it the first crypto that I bought? Is it the most recent crypto? Is it one in the middle? And this is a question of identification. And the IRS clarified that the default is typically FIFO, or first in, first out method when you sell your crypto. So the crypto you sell today was the first one or the oldest one that you bought. And as you sell more crypto, you go to the oldest first. That's the FIFO method. But the IRS said in their recent guidance that as long as you can make an identification of your crypto, you could identify when it was bought, the acquired price, the date, then you can specifically identify which crypto you want to sell. Which means that if I have Bitcoin that I bought at all different prices, from $5,000 to $10,000, and then today the price is $10,000 and I want to sell some today, I can decide, do I want to pick the crypto out of my wallet that I bought at $5,000 or $6,000 or $9,000 or $10,000? And why does this matter? Well, the effect is that you can influence your gains or losses in your current year by selecting which crypto you want to sell. So if you want to minimize your current year gains, you can pick crypto that has a higher cost basis and sell that crypto first. If you have losses in other cryptos and you want to pick up more gains this year to offset that, then you would pick the crypto that has a lower cost basis. So the IRS allowing people to use the specific identification method is actually a great victory. It allows us a lot of tax planning opportunities and ways that you can minimize your current year taxes. In order to do that, though, you need to know what you're holding, and you need to have a reconciliation of what you have currently in your wallet. So that way you could figure out, this is what I'm holding, this is my cost basis in each of these tokens, and so I can pick out which one I want to sell first. There had been a lot of question leading up to the IRS guidance as to whether or not this method was permissible, or if you could use methods such as LIFO, which is last in, first out, or even an average cost method. The IRS has now said FIFO is the default, but you can use specific identification as long as you're able to identify your crypto, which in most cases people can in fact do. So another question that often comes up is about using foreign crypto exchanges. From a tax standpoint, from a legality standpoint, the IRS isn't concerned with you using a foreign exchange and whether or not it's restricted for U.S. persons. The IRS wants you to report everything on all exchanges. And now, more than ever, even foreign exchanges, and one of the first was Bitfinex, they're providing information to the IRS and U.S. government. And so all trades, no matter where they occur, if it's on a U.S. exchange or a foreign exchange, needs to be reported. A lot of people, though, tell us, hey, my exchange closed down. I was either on Mt. Gox or more recently Poloniex, which restricted U.S. customers. and I either lost coins or I can't get access to my records. Well, let's break these down. First, if you lost access to your records, often we're able still to reconcile and identify what went into a closed exchange and then if there's anything that left. And so it's still possible in many circumstances to reconcile those trades. But what happens if you trade or transfer crypto to an exchange and then it closes down? Crypto's lost. It was hacked. It's gone. In those cases, you can potentially take a loss for the amount of your cost basis. So say you bought Bitcoin for $5,000, transferred it to a foreign exchange, and then that exchange closed down. You can take a loss for the amount of your cost basis or what your purchase price was. And this is true not just with hacked or closed exchanges, but in general, one of the questions that someone just asked was if you can write off your losses. And so if we're talking today about U.S. taxation, and from a U.S. tax standpoint, crypto losses can be taken. They can be used in a variety of ways. First of all, if you have losses from your trades in crypto, it's always important to report them, not just gains, but also losses. These losses can be used to offset any current year gains from crypto trades. So say you're trading a bunch of crypto, you've got a bunch of gains, but then you're holding some crypto losses. Those losses could be sold and that loss used to reduce your gain from other crypto and or other stocks or property. So you could potentially have a gain from the sale of your IBM or Apple stock because you're a better stock trader than you are a crypto investor, and then a bunch of crypto losses, and you could sell the crypto, use those losses to offset your stock gains. So it doesn't only have to be crypto gains that you're offsetting. Well, what do you do if you have no gains at all? In that case, you can take up to $3,000 a year of losses and offset other income. So say you're working at a company and you receive a W-2. You can have $3,000 a year of crypto losses to reduce your ordinary income, your other income as well. So it's not only about gains. But one of the best advantages or reasons why you want to realize losses in the current year is that you could carry forward those losses to next year. So if you have a bunch of losses this year, it's okay to realize those, because next year, if you have gains, those gains could be reduced by your losses from the prior year. You can't take losses this year, unfortunately, and carry them backwards. You could carry them forward, but not backwards. So a lot of people had losses in 17 and then gains in 18, perhaps losses again. You can't carry back the losses from 17. I'm sorry, you can't carry back the gains from this year to 17. You can carry losses, though, forward. And so one of the other strategies that we use with a lot of our clients is tax loss harvesting. And what this is basically if you're in a position where you're holding crypto that has unrealized losses, you bought it at a price that was higher than it's selling for today, you can sell your crypto and realize losses and then harvest those losses for future years or for future gains. And one of the other strategies that we often use too is that you can sell crypto, realize losses, and then buy it back. So that even if you want to be long in crypto, there's still ways to do it while still realizing losses. So it's an important strategy that people should consider as well. Let's see. One of the questions that people asked was how to start in crypto. I have no idea about this and which one's reliable. Not really a crypto tax question, but overall I'd suggest people just wanting to get involved in crypto to begin with, use one of the large US-based exchanges, Coinbase, Gemini, you can't go wrong with them. Also from a tax perspective, one of the things you want to be aware of with exchanges you use is to make sure they have reporting functions. Because the requirement is on you as a US person to report your taxes. It's crazy, right? I have to calculate my gains, I've got to report it, and then the IRS can audit me, and I've got to prove everything on my tax return. So in an audit, it's not the IRS that has to prove that you're wrong. You have to prove everything on your tax return. So it's really important to have exchanges that have records because the burden is on you to show cost basis and to be able to show the calculations of your gain or losses. Let's see, what other questions? So one of the questions was, this is my third year trading cryptos and I've yet to report. Will I have to report for 17, 18, and 19? So this happens all the time. We get this question all the time. If you haven't reported in prior years, but you have activity, first of all, you definitely need to report this year. Okay, without question, your 2019 tax return, you need to report. And as we talked about in the beginning of this video, there's now a new question on the tax forms. Schedule 1, very first question asks, at any time in 2019, if you had crypto, if you sent, sold, received, or acquired crypto. And you have to answer this question truthfully, and it's a yes or a no checkbox. And so the IRS is now making it apparent and front and center, the first question on the tax return, saying you have to tell us if you had any crypto transactions during the year. So first of all, if you had trades during 19, it is crucial. You have to report it. But what do you do about the years before? Well, in order to prepare 19, you need to know cost basis from earlier activities. So if you were trading in 17, 18, and then 19, you can't just prepare your 19 tax return without your cost basis information from 2017 and 2018. It'll flow through to 2019. Now, in theory, you could do 2019 and just pick up zero cost basis, but that would be to your disadvantage. Instead, what you should do is start reconciling from the oldest year forward. So reconcile from the first time you bought all the way to the current year, calculating your gains or losses in each year and carrying forward your cost basis into any new acquired tokens. Then in 2019, you'll be able to have a full and complete report. But what do you do about the other years? Well, for the earlier years, in most cases, it makes sense to amend. But it's a decision that you and your tax professional should discuss on a year-by-year basis and decide does it make sense to amend. Now, typically it does, but there are other considerations involved as well. Because, for instance, the IRS typically has 3 years to audit your tax return from the time that you filed. Now, this can be extended. They can have up to 6 years if you underreport your income by 25% or more. But typically, they have 3 years. So one of the considerations is whether or not you should amend based on the statute. Also, the level of income or gains that weren't reported, as well as the current year effect. But overall, you want to start with the oldest years and then reconcile 1 year after the next. One of the questions that we're often asked is it going to raise red flags? Am I going to be audited if I amend my return to report crypto? In our experience, actually the opposite is true. That if you proactively report your crypto, amend your tax returns, that the likelihood of audit or further inquiry by the IRS has greatly been reduced. If you don't report crypto on these years, we are seeing more and more audits of people that the IRS is alleging that they have crypto and they didn't report it. And it makes sense because the IRS is getting a lot of information from exchanges on U.S. persons, and so it's easy for them to see in those years, did you have any activity? Did you have anything reported on your return? So one of the best ways to minimize your chance of audit is to amend your tax return to report all your crypto trades, all of your transactions. And that's true even if you have a loss. We had a client recently that had hundreds of trades, and he didn't report anything on his tax return. And instead, Coinbase sent to the IRS a form called a 1099-K that said this user had a lot of activity on Coinbase. Many of the viewers here may also get this, but nothing was reported on the tax return. And so the IRS got this form from Coinbase and therefore was able to say, hey, you owe us all this money because you had all these trades and you didn't report. The Coinbase form showed $1 million. The IRS sent him a bill for $400,000. He thought he had very minimal gains or maybe even a loss. And after we reconciled it all, he was in fact correct. He had only a few $1,000s of gains, but he did have $1 million of trades. So one of the best lessons and tips I have for people is even if you have small gains, even if you have losses, report it because you're going to get ahead of potential issues with the IRS. If you don't report and then they get information from Coinbase, for instance, you might be very unlucky and just get a big bill from the IRS. And then the burden would be on you. You would have to fight it. You'd have to explain to the IRS why it's incorrect. So much better to just prepare it yourself. So another question was asked about mining and how mining is taxed. And the IRS has actually been pretty clear on this as well, on mining and its tax. So depending on the type of mining, proof of stake versus proof of work, for example, there's different types, but most mining overall is like running a business. And the IRS would see it as running a business. And what this means is that all of your mining rewards, all of your payouts, it's income to you. It's just like you got paid for doing a service. It's like you got paid for mowing a lawn. You processed computer transactions, you mined, and therefore you got a payment. This payment just so happens to be in cryptocurrency. But the IRS says you have to value this cryptocurrency at the time of receipt and then pay tax on that amount. So let's say I mined today and I received 0.1 Bitcoin, and today Bitcoin is worth $10,000, so 0.1 is worth $1,000. I would have to report on my tax return today $1,000 of income from that mining activity. But let's say tomorrow the price of that 0.1 Bitcoin drops to $500, gets cut in half. Well, then I still had income today of $1,000. I just now, when I sell the Bitcoin, and let's pretend I sell it, I now have a capital loss of $500. So I would report to the IRS in mining at least two parts. I would report the income at the time of receipt of all the mining, and then when you sell it, you also have to calculate the gain or loss on the sale. And so the gain or the loss is the difference between the value when you mined it, the income, and then the sales price. So in our example, we mined it and it was worth $1,000. Then the next day it dropped to $500. We would have a income of $1,000 and a capital gain of a capital loss rather of $500. So there would be both parts. So mining, it's a little bit more complicated. You have to take into consideration both aspects, but also expenses. So mining, you'll have computer, electricity, rent, all those types of expenses you also can account for and get a deduction for. Sometimes expenses are paid in crypto, and every time you pay for an expense in crypto, it's like you sold that crypto for cash and you use that cash to pay for the expense. So it's fine, you can pay for expenses in crypto, it just adds a little bit more work in terms of reconciliation. Let's see what other questions we have. Do I think the Bitcoin price will go up now? I'm not a financial advisor. I'm really not sure. I wish I had a crystal ball, but I personally am long in Bitcoin. Okay. Do wash trading rules apply to crypto? Good question, Brandon. So earlier on this video, I talked a little bit about selling crypto to harvest losses. And I also mentioned that you could buy back your crypto after you've sold it if you want to stay in a long position and hold crypto. Well, in the stock market, with stocks, if you sell a stock and realize a loss, you have to wait 30 days in order to buy it back. Otherwise, it's considered a wash sale and the loss is disallowed. So I'm going to say this again. With stocks, if you sell, for example, Apple stock at a loss, but then buy back Apple stock within 30 days, that first loss is disallowed, considered a wash sale. But what about crypto? What happens if you sell Bitcoin on December 25th to realize a loss, but then buy it back on January 1st? Is that still a wash sale? Well, this is still kind of a gray area in the IRS world, but an area that we feel comfortable taking a fairly aggressive position in saying that wash sales generally don't apply to crypto. And that's because the law, as written today, says that wash sales apply to the sale of stocks or securities. And this is important because most cryptos, or many cryptos, I shouldn't say most, many cryptos at this point are not considered securities. And we know, for instance, the SEC has expressed opinions on Bitcoin and Ethereum that they are not, for instance, securities. And so if you're not a stock or security, then you're not subject to the wash sale. And so this means, for instance, with Bitcoin, we can sell it, realize a loss, and then pretty quickly buy it back. Now, in the IRS world, there's the concept of economic substance, which means you can't just do something that really doesn't have an effect just for tax purposes. So you should wait at least enough time so that there's some fluctuation or risk to the price of Bitcoin. But otherwise, generally, you can sell crypto, realize a loss, and then buy it back and still have that loss. Another question is, well, what if you've only been holding and you've never traded, you've never cashed out? In that case, and this is one of the few cases that you don't have any taxable transactions to report on your tax return. So it's only taxable when you sell, when you exchange crypto from one to another, when you buy something with crypto. Say you buy a computer on Newegg or a Lamborghini with Bitcoin. That is like you sold the crypto. So even though you didn't cash out, it's still reportable. But if you only held, say you bought Bitcoin in December 2019, never sold, never exchanged, never changed it, then you won't have anything to report on your tax return. But if you exchanged, you did anything with it, then you do potentially have a reportable transaction. A similar question is if you transfer from one exchange to another. That also is not taxable. It's not reportable. So if you transfer Ethereum from your Coinbase wallet to your Poloniex wallet, for instance, not a taxable event. If there was a fee, perhaps you have an addition to your cost basis. But otherwise, there's no taxable event just transferring or moving crypto between wallets or exchanges. But every time you have any type of conversion, you sell, exchange, anything, then you do have a reportable event. Let's see if there's any other questions. So one of the questions was, well, what about cryptocurrency that's perhaps anonymous, or even mining, which goes to an address but doesn't go to your name? So even with privacy coins, anonymous coins, or even mining that perhaps isn't in your name, all of this still needs to be reported. And the IRS is getting better and better at finding anonymous and private information. And a lot of it we could even trace ourselves. And so if we can do it, so can the IRS. And this is for a number of reasons. One, even with privacy coins, there's generally on or off ramps to other coins or to fiat. And that's traceable. And so there's a lot of different ways that even that the government can trace your transactions. But even if they couldn't, the obligation is on you as a taxpayer to report all of your transactions and pay taxes on it. And so it's not a matter of whether or not the IRS could find you or trace your transactions. It's the law. You have to report your trades. But I would also warn that even if you're not of that opinion and you hate tax, which we all do, that the IRS can and will be able to identify and trace a lot of transactions. So one of the other questions was, is it better to buy things with crypto or should we convert it to USD? So let's first talk about what happens, for instance, if you use a crypto debit card or if you're just using crypto to make purchases. Every time there's a transaction, it's actually a taxable event. So let's say you used a crypto debit card to buy coffee at Starbucks, and that coffee was $5. You then would sell 0.001 Bitcoin, and it would be equivalent to $5. That transaction there would also be taxable and reportable. So that coffee may not just be $5, it would be potentially $5.01, or maybe it's $4.90, depending on how the value of crypto changed relative to your purchase price. It's not so much, in my view, that you have to pay, that you'll have a gain or loss every time you use crypto to buy something. You know, that potentially is a pain. But what I think is really the issue is that it has to be reported every time. And so if you're using a debit card or you're just paying for items with crypto, each transaction is a line item on your tax return. And so it's a long process. Contrast this with just selling for cash and then using the cash to purchase things. It could be a lot fewer transactions. So, for example, if you sold one Bitcoin for $10,000 and then put $10,000 on a prepaid debit card, now we only have one transaction, one reportable trade on your tax return from Bitcoin to cash versus every time you bought something with that Bitcoin, in which case each of those individual transactions would be reportable. So overall, crypto debit cards are really cool. I think it's great for crypto adoption, but from a tax perspective, it could be a big pain. Now, doesn't mean you shouldn't get one, doesn't mean you shouldn't use it. Just beware of the tax consequences, or hire a firm like us to handle it for you. Let's see what other questions. So if I lose a private key and no longer have access to my crypto, can I claim that as a loss? So very common question. Happens with lost wallets, lost keys, hacked exchanges, all sorts of things like that. And the IRS has yet to define exactly how you can treat these things, but in many cases, we're comfortable taking the position that it's basically a worthless property or a worthless security, in which case it's sold for zero. And the result then would be you have a capital loss for the purchase price or your basis of that hacked or stolen crypto. So say you bought it for $5,000, then it was worth $10,000 when it was lost. You will take a loss for $5,000, the purchase price, not the value when it was lost. Now, I should say this is a more aggressive position. The IRS hasn't issued explicit guidance on this, and there is a huge downside if you later find the crypto. Or with exchanges, we're seeing some of these exchanges, most famously Mt. Gox, is likely going to pay out people that initially had money on there. And so if you take a loss, but then later get a payout, or it's not hacked, or you find your wallet, you find your coins, the time you find it, now it's income to you. And it also resets your holding period to that date. So I would be very careful before taking a loss for any hacked or stolen crypto, because if you later get it, the tax effects will be much worse. You'll have ordinary income and you'll reset your holding period, both things being negative to you. Another question is, can you pay taxes with crypto? So some states have been experimenting with accepting crypto as tax payments. As of now, the federal government, the IRS, as far as I know, does not accept crypto. But perhaps times will change, and maybe they will in the future. But even with the states that do accept crypto, it's very important to realize that if you're paying taxes in crypto, that's also a taxable event. Excuse me. You'll have to report that trade because it's basically like you sold crypto for cash to pay your taxes. So paying taxes with crypto, not always the best thing too, because it'll create another tax event, and you may even have tax to pay on the tax that you're paying for crypto. So all things to keep in mind. Got a few more minutes left, so we'll wait and see if there's any other questions. But in the meantime, if any of you do have any questions later on, feel free to reach out to me. My firm prepares tax returns. We do crypto reconciliations for people. So even if you want to use your accountant, but you want us to do the crypto, we can handle all the crypto, give you a report that your accountant would be very familiar with, or we could handle your entire tax returns for you. We've seen all sorts of things, be it simple traders to large-scale, high-frequency traders to crypto businesses. We've seen all sorts, and we can handle it all. Let's see. So yeah, and then someone else had said another good piece of advice is print out, keep track of all your records, especially with exchanges that close. Sometimes, for example, Poloniex closed down to U.S. customers, and so people for months, it wasn't until yesterday that some people are now finally getting access to their records. But you should get in the habit of saving your records, exporting from exchanges, all of your records. That way you have files, so even if the exchange closes down, you have those. And then usually what we would want from our clients to prepare crypto tax returns is all the raw exports from exchanges, because this is also what the IRS in theory would get, and it's what the IRS would look to in an audit. So we would start with all the raw transactions and then reconcile them to create reports for you. I think one other questions, and maybe this will be our last question, so very good questions. What happens if you can't pay your taxes? Can you settle your crypto taxes? In some cases, actually, the answer is yes, that the IRS will settle with you, but it is almost completely dependent on your financial situation. So you can't just go to the IRS and say, well, my tax bill is $100,000, I'll give you $50,000 now. It's not the way it works. Instead, if, for example, you owe the IRS $100,000, but you were retired, you had a limited retirement account, you had no other assets, no other ways to pay this, then perhaps the IRS will settle. Or you had a tax bill from 2017 for $2 million of crypto trades, but you only have $1 million of crypto today. And potentially then the IRS would settle. But again, it all depends on your financial situation, not what you owe and not what you're willing to pay, but your finances. Overall, if you're afraid that you're going to owe the IRS and that's why you haven't reported your crypto, I would strongly advise against that. It's a different thing to not file than to not pay. And the most important thing is to file and report your crypto. You can always work out a payment plan or a settlement with the IRS, but you have to report. And that's often what gets people into even more trouble, is when they don't file their taxes and they don't report their crypto. So let us help you if you owe the IRS. Don't be afraid of the tax balance. We could work out something with the IRS, but you do need to report it. I guess final question is, if it's not tax season, you don't have to just file amended tax returns during tax season. You could file tax returns at any time. You could also file late at any time. So sooner the better would be my advice. But it doesn't have to be explicitly during the tax season window. It does have to be during that window to file on time and not be penalized or pay interest. But if you're late already or you need to file amendments, the sooner the better, but it doesn't have to be at a specific time. Thank you all for watching. As I said before, feel free to reach out to me if you have any additional questions. Excuse me. My name is Andrew Gordon. I'm an attorney and CPA. GordonLawLTD.com. GordonLawLTD.com. Thank you all.